Hi guys. Today we will analyze Kraft Heinz stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, the stock is an average performer. Both the short-term and long-term trends are positive. Support levels are around $42 and $37.50. Next support levels are around $35.20 and $33.20. Resistance level is around $44.10. In the last month the stock has been trading between $39 and $44.50 range. It is currently trading in the middle of this range. The stock has an average volume of 6 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 0% per year, for last 5 years. We see that the average profit margin of the stock has been around 3% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 356% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Kraft Heinz Company: bad, average, and good. First scenario. Kraft Heinz will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 0%. Future profit margin would be low, 3%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $13. Second scenario. Kraft Heinz will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $18. Third scenario. Kraft Heinz will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $25. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 0.82. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Kraft Heinz, analysts forecast growth rate around 2% per year in next 5 years, and future P/E around 16. Again, I will use 3 different scenarios for Kraft Heinz Company: bad, average, and good. First scenario. Kraft Heinz will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 0%. Future P/E would be low, 20. In this case, the fair value of the stock today would be $7. Second scenario. Kraft Heinz will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future P/E would be average, 24. In this case, the fair value of the stock today would be $9. Third scenario. Kraft Heinz will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 28. In this case, the fair value of the stock today would be $12. As you can see, today the stock is overvalued, $42, even if we expect the company's high performance in future. The company has a medium profitability rating, but doesn't score well on its financial health evaluation. Based on estimates for the next 5 years, the company will show a very small growth in revenue, 0 to 2% per year, and the stock is overpriced at the moment. The stock's fair price is below $25. Company's strengths. Kraft Heinz is an American multinational food company. It's the third largest food and beverage company in North America, and the fifth largest in the world. In addition to Kraft and Heinz, over 20 other brands are part of the company's profile, including Oscar Mayer, Philadelphia Cream Cheese, Maxwell House, and other. The company is a large, well-run consumer staple. The consumer staples sector has historically been a strong place to be, in times of economic recession. Kraft Heinz is protected from inflation, due to its pricing power within the packaged food industry. Kraft Heinz has continued to commit capital to paying down debt, reducing its total debt by $6.5 billion in 2021, while maintaining its dividend of $1.60 per share. Kraft's return on assets of 1.3% is in line with the rest of the industry. Its profit margin of 5% is amongst the best of the industry. Risks. Moving away from declining product segments, where the company has some of its strongest brands, is a long and painful process. The current strategy to improve profitability and free cash flow does not offer a radical solution to the company's weak strategic positioning. Interestingly, Warren Buffett himself once noted that Kraft Heinz has lost bargaining power with retailers. Changing consumer preferences, and increased competition from other brands, as well as retailers' private label products, have shifted the competitive dynamics for this industry. Other risks include accelerating cost inflation, weaker than expected pricing, execution risk, distribution losses, market share losses in key categories regions, which could lead to more promotional activity. Unfavorable weather could place upward pressure on input prices for products, such as dairy, coffee beans, meat, wheat, soybean and sugar. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Kraft's return on equity of 2.5% is worse than the rest of the industry. The industry average return on equity is 10%. Based on estimates for the next 5 years, the company will show a very small growth in revenue and earnings per share. The revenue will grow by 0 to 2% on average per year. The EPS will grow by 2 to 3% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.